You're ready to invest. You've taken care of your financial fitness. You know you want to think about your future. You just don't know where you go next. My name's Daniel, and in this video, I want to talk about the 3 paths that are in front of you, the 3 roads that you can choose as you begin your investing journey. Let's jump into them with the first one, which is probably the right path for most investors: indexing. What is an index? An index is just a list. In the back of a book, you might see a list of all the proper nouns in the book: the people, the places, the names, the events, so on. In the stock market, an index is a list. It's a list of stocks, a list of companies. It represents some section of the market. The 3 indices that you're most familiar with as a US investor or somebody in the US, and probably globally too, are the Dow Jones Industrial Average, which was one of the first indices, the Nasdaq Composite, and the S&P 500. We're going to focus on the S&P 500. The Nasdaq Composite is interesting. It's faster growing, but more volatile. It includes a lot more technology focus than the other indices. It's viable, but we're going to set it aside. The Dow Jones Industrial Average is just older fashioned and jankier, so we're going to just leave that aside right away. The S&P 500 comprises of 500 of the biggest companies in the United States. It's one of the biggest indices in the world. It's the most common representation of what's happening in the US stock market. Each country has their own index or indices, and those are options to invest in if you're in those countries. And maybe we'll talk about investing in other countries later, but the S&P 500 is going to be my stand-in. Indexing is investing in the index via an index fund, an exchange-traded fund that is readily available to buy or sell any day when the market is open. Why would you go this route? A few reasons. First of all, it's cheap. To invest in an index fund, you have to pay the manager of that fund on an annual basis about 3 to 9 cents for every $100 you put in. That's not very much. That means you're going to keep track with the average. The average is pretty good, which is the second reason. In the last century, the S&P 500 has returned about 10% a year on average. That's pretty good. Even if you take a bad starting point, like January 1st, 2000, at the peak of the dot-com bubble, from there to the end of last year, which was also a bad year, by the way, the S&P 500 returned 6.5% on an annual basis, on average. Not great, but not terrible. It's hard to beat that average, and sometimes you just want to have the average. The last reason to go this route is it's easy. You have to set up a brokerage account. You have to buy the shares of the fund originally. You have to keep buying shares over time, but it doesn't take a lot of work. You don't have to study individual companies. You don't have to worry about putting all your eggs in one basket. You immediately get access to 500 of the biggest companies in the US without any extra effort. And so you just invest in the market that way. You get to leverage the economic growth of the United States. It's not so bad. It's a pretty easy route. The trade-offs. Why wouldn't you index? You do have to do some work. So if you're really lazy, or if you don't want to spend the time to start this up or to keep doing it over time, maybe that's not for you. You also have to have some stomach for this, because you can't totally ignore it, because the best strategy is to continue buying shares over time. Maybe you can set that up automatically, by the way, but if you can't, you do have to go and look at it. And sometimes the stock market will go down, and you have to be comfortable with that. You can't sell at the bottom for this strategy to work over the long term. You have to let the market work for you, even through the down times. You have to keep adding over time. And the last reason that you might not want to index is if you think you can do better than average, which, good luck. We'll talk about that. It's possible, but it's not easy. I say that it's good to index, but I'm not the only one who says it. Listen to this guy.
I think it's the same thing that makes most sense practically all of the time. And that is to consistently buy an S&P 500 low-cost index fund keep buying it through thick and thin, and especially through thin.
When Warren Buffett says something about investing, I tend to take him seriously. So indexing is the easiest path, and it's probably the most suitable path to begin your investing journey. Let's say that you just heard my talk on indexing and you still feel like it's not for you. Too much work, too much stress, whatever the case may be. The second path may be the one that's more interesting. Find somebody you can trust to invest for you. The benefits of this path are that you don't have to think so much about your investing. You can sleep better at night, you don't have to spend any time on the market, and you have somebody who's minding the shop for you, who's building towards your future. This can be a real value. Peace of mind does count for something. The flip side to this, the costs of this, are twofold. First, you have to find somebody you can trust. Yes, there are crooks out there, but I don't necessarily mean that. Most people are not. But still, you need to find somebody you can trust to know what they're doing, to know what they don't know, to stick to their limits, and to stick to what makes sense for you. Most advisors know how to do that, but that's still something you need to feel good about. Then, you do have to pay them. Of course, they're giving you a real service, they're giving you that peace of mind. The problem is, the more you pay them, the harder it is for them to provide you a service comparable to what you would get from indexing. The most I would pay an advisor is 1% of the money that I give him or her. For that 1%, in that case, the advisor, to get the comparable return to the index, has to beat the market by at least 1%. That's hard to do for anybody. And so maybe that peace of mind is worth that 1%. It could be a real value, but that's something you have to keep in mind. If they're doing something simpler than selecting stocks, then you also have to think about, what am I paying for that I couldn't do myself? So those are the trade-offs. For 1%, maybe they're picking stocks and maybe those stocks are good enough to beat the market, but it's hard. And if they're doing something simpler, you might be able to learn how to do it yourself. Again, you may not trust yourself to do it, which is why this path is attractive, but those are the pluses and minuses of finding somebody you can trust to invest for you. The last option available to you is to choose to learn how to invest yourself. This can be a really rewarding path. It's not easy. You're not going to beat the market necessarily. I'm not talking about financial rewards, but the things that you learn as you become an investor can be invaluable, not only within investing, but in your broader life. You learn a lot of analytical skills, not necessarily math. You don't need complicated math, but you learn how to find information, how to evaluate information, how to think about why businesses work or don't work, how to think about the future, not necessarily predict the future, but understand what might be coming, how to process information. All of that is super useful. And then you get great skills from decision making, because you're making decisions every day on the market, and the market is telling you you're wrong every day or you're right every day, and you have to sort that out, and you have to understand, okay, was this information useful or not? Did I make the right call or not? And you have to do that day after day, month after month, year after year. The stock market is a great crucible for decision making and a great gym to train your decision making skills. The last thing that you'll get out of investing is you learn about the world. Investing is a window into the world. You get to see trends that are happening. You get to learn about what happens in different places. You get to just understand the world through a different lens. That can be a lot of fun. The trade-offs are that it can be really hard to invest on your own. It's hard to beat the market. Professionals really struggle to beat the market. It'll be just as hard for you. And so financially, it may be better to just index. Then you're putting real time into all of this. I would benchmark something like 10 hours a month as the time you'll need to put in once you've learned how to invest and have started buying stocks. 10 hours a month plus all the startup time is a real amount of time. So when you're comparing it to what you would make from just indexing, you have to factor in that you're also putting a lot more time into it. You can factor in the benefits as well, but keep in mind, this is a real time investment as well as a money investment. The last thing that you have to keep in mind is that investing can be stressful. You're taking the benefit of you're getting control of your financial future. That can be rewarding. The trade-off is it's on you. If you make a mistake, you can't blame anybody but yourself. If you get something wrong or if you follow somebody and then it doesn't work out, that's on you. And you have to be able to ride out that stress. You have to be able to take that market feedback professionally and as a grown-up and learn from it. And you have to be able to ride it out when you actually might be right, but the market is telling you otherwise. The worst thing you can do is to change strategies when things are going wrong and you sell at the bottom. I mean, if you have the wrong strategy, you should change, but you want to pick strategies that you can ride through the hard times to get to the good times. And so that can be hard. That requires a lot of discipline and stomach. And so that's why you might not want to go down the path of learning how to invest yourself. One thing I should say before we wrap up. It's not all or nothing. These are 3 paths, and I've set them out as different paths, but you can go on more than one path at a time. For example, you can start indexing and then save up, let's say, 5 or 10% of your money and start investing it on your own. Or you can put that money with an advisor and then again, take some small percentage of it and try to invest yourself. If the advisor's a nice person, maybe they'll even give you some ideas or feedback on what you're doing. They are 3 separate paths, but again, they're not mutually exclusive. You can decide what's best for you and you can decide how you want to experiment. You can even change your mind later and say, that investing by myself wasn't for me. I want to go to the index, or I want to find somebody to help me. So just keep that in mind. The journey of 1,000 miles begins with the first step. Your investing journey begins with deciding which investing path you want to go down. I laid out these 3. Each one of them could be suitable, though indexing, again, is the best option for most. But they're all available for you to choose from. And again, it's not all or nothing. That said, whichever path you go down, you need to have the right mindset to succeed as an investor. That's what I talk about in my next video, which is already available on this channel. Subscribe to this channel to get all my videos. Check out that video if you'd like. Check out shortinvestingguide.com to see these videos in article format and to get more materials. And get in touch if you have any questions or any ideas for future videos. And thank you so much for watching. I hope you enjoyed this. I wish you luck in starting your investing journey, and I look forward to seeing you next time.